I want to be humble in this video. I don't want to underestimate the power that sellers have in this market. When sellers come and they come with their tickets trying to sell and there aren't buyers there, sell-offs typically happen. They will just reach downward to just try and find anyone who will accept the price and the offer that they have. And that effect can compound on itself. And it's entirely possible that effect will compound on itself beginning here. And that is possible. Now, do I think that should happen? No. Let's talk about what caused today's sell-off and what are the reasons behind it. As interest rates tick up, which they are for whatever reason, we don't know. It could be inflation, could be the reopening of the economy and expectations for a hot economy, as some people have said, which I don't really, whatever. As interest rates tick up, bonds become more attractive. At least they return they have a better ROI. And as bonds have a better ROI, there's less reason to look for stocks for an ROI. So given such a strong move in bond yields, there are fears that people will begin to take stuff out of stocks and move it into bonds that will start offering better yields. Now, do I think bond yields are a good investment? They certainly have not been for the last several months, if not year or two. Bonds have been priced less than the average rate of inflation, and we are in what I believe is a relatively high inflationary environment. So if you ask me, bonds actually have a negative real rate of return, despite some somewhat positive nominal rate, of 0.5%. But when the inflation rate is on average 2%, or that's what the Fed desires, now they're desiring more, a 1.5%, which is this current rate that the bond yields shot to today and is freaking everyone out, is actually, in my opinion, a bad investment and seems to, in real terms, be a negative yielding investment. So, is that what caused the market sell-off today? It's possible. What I think caused the market sell-off today was that chatter and then sellers looking at the current price and being like, ooh, I got to be the first one to get rid of my stocks and lock in my gains. And it creates that sort of dynamic. Now, let's forget about these weird dynamics, bad investments, and all of this. Let's focus on the fundamentals. Today, we got some very compelling information out. Jobless claims were over 100,000 jobs less than expected. That's a good thing. We want less people getting fired. Now, these numbers are still incredibly high. We need people to get back to work. People in DC, hope you are listening to this video, but you're probably not. And that's good for the economy. We really just need people to be working. And for the most part, they are. It seems to me like the people who aren't working are those who are enjoying the unemployment. I'm not trying to make a blanket statement like that, but the small businesses I talk to say their problem is they can't find people to hire. Spending seems to be good. Durable goods spending is very strong. Airplanes apparently up 60% or some crazy number like that. So there are reasons to be bullish. For the most part, companies have been beating earnings expectations and improving margins. So the fundamentals, ignoring the bond crap and ignoring the, effect of sellers just trying to find a buyer crap, are actually not that bad. Now, the most important force, I believe, in all of this is inflation. We have pumped a lot of money into the system, and this might be the reason bond yields are ticking up. Maybe, I don't know. As inflation occurs, the value of the dollar decreases. So the dollars you're getting back from these bonds isn't worth as much. So you need more of these dollars to come your way. So maybe that's why interest rates are increasing. Maybe it's a combination of the two. A reopening economy, that kind of stuff, less, need for just a cash flow, kind of like that. And part inflation. Now, for stocks, as inflation occurs, it's very difficult for stocks to go down in that environment because let's not forget, stocks are companies that sell goods. Inflation is an increase in the price of goods. So as companies experience inflation, they increase their prices. And that hypothetically will increase earnings. Now, we don't know how this inflation is going to kick out. Is it just going to be ceteris paribus across the board? All inputs going up at the same rate that outputs are going up and labor's going up? We don't know. We'll have to see what happens. Overall, I think it's very difficult for stocks to go down and for inflation to go up. That picture just does not sit in my head as a possibility. Just in the same way that if inflation were to go the other way and there were to be deflation, I could not see stocks going up. So I expect there to be some inflation, and I expect, yes, stocks to continue going up. Now, the last thing I will talk about, and I don't like talking about this kind of stuff, but people want to hear it, and it makes a whole lot of sense. We have recently, at the top, broken 3,900 on the S&P. We hadn't broken 4,000, we had broken 3,900. With the sell-off, we had not broken 3,800. We had gotten close to it, but not even that close. We were still 3,800 and teens. It's not like we got to 3,800.05 or, 1, 3,801, 2, 3. No, 3,800 and teens. That's solid cushion. In addition, today's low was not as low as the other day's low. So we didn't get to the new lows of this sort of trend. We were above that level at today's lows. Not saying that is an absolute sign. I'm saying that's an optimistic sign. And it's something worthy of note when you're looking at the supply and demand dynamics that we talked about at the first video of sellers kind of coming in and maybe or maybe not finding buyers. There were, allegedly, slightly more buyers this time around, despite there not being a Powell speech 30 minutes into the session, which takes us back up. This was, a naked session. Just kept going down, basically. So, at the end of the day, I think this is some sort of just paper hands, weak hands, weird justification for a sell-off. Bond yields taking up to 1.5%. Are you kidding me? It's not like that's a good investment. 1.5% on a U.S. Treasury when the U.S. is printing a ton of money. It's not, in my opinion, a good investment. No reason to be concerned about people selling Apple and Amazon to buy a 1.5% U.S. Treasury bond when Bitcoin, in my opinion, might be going somewhere with that. So that's the deal for today. I understand it's a whole lot to digest, but we'll have to see what happens. These are just thoughts. We really just got to see what happens. Give it time. I'm remaining long. I'm not selling anything. I'm buying farms because it seems to me like the bond market might be sniffing some inflation, and I'm pretty sure that's going to happen. Got the gold rolly for a reason. So I'm buying farms, which will adjust in an inflation environment. Farms have typically done well in inflation economies. And not selling because I don't want cash. So it's a lot to digest. Feel free to comment. Feel free to hit me up. Like, share, subscribe. Typical YouTube stuff. And until next time, peace out.